In this slide presentation, we're going to cover how to create sustainable wealth with infinite banking. This presentation has been developed by Isis and Pedro Palicio, Nelson Nash Institute, Infinite Banking Concepts, Authorized Practitioners. This is part 1 of 2 of the presentation. How to measure wealth. Wealth should not be measured by net worth. You are truly wealthy when you have assets that consistently and reliably generate cash flows that are many times larger than your expenses. The financial problem in America. Too many Americans follow the gurus when they tell them to put a small sliver of their paycheck into a highly restricted stock market investment program, also known as tax qualified plans, so that they cannot touch these savings until decades later when they retire. In the meantime, when these people need to spend money on big ticket items, they are counseled to do what everybody does, go to outside lenders. The result, which Nelson Nash describes early in Becoming Your Own Banker, is that the typical American is swimming in debt, with a large fraction of his monthly income devoted to paying interest to outsiders. A few words about tax qualified plans. Would you go into business with your best friend if he demanded that you put all the money? If he required that you let him make all decisions as to percentage of ownership, when money was split, etc.? If he reserved the right to change anything, anytime without your consent? We don't think anyone in his right mind would do so. Yet, that is exactly what you are doing if you participate in any tax qualified plan, such as a 401k, IRA, pension plan, etc., and you are dealing with a partner that has a perfect record of lying to you. Rethink your thinking. The fundamental change in thinking occurs when people rethink their thinking and flip this arrangement. Rather than giving away our savings to the control of outsiders, so that we must approach outsiders hat in hand whenever our expenses exceed our paycheck, we can instead begin to capitalize our own bank. That is, we direct as much cash flow as possible into building up an asset that we control, so that we turn to it when we have to buy a car, pay for a child's wedding, make an attractive investment, or even buy a house. Introducing clients to the infinite banking concept has allowed them to instantly retake control of their financial situations and over time to find themselves wealthier than they otherwise would have been. Let's talk about process and platform. Nelson Nash Infinite Banking Concept is a process. It is an excellent cash flow management strategy to take care of your personal or business economy. In the world, as we find it, by far the best platform on which to implement the infinite banking concept happens to be a properly designed high cash value or life insurance policy through a mutual life insurance company. We cannot solve our problems with the same thinking we used to create them. We're moving to what we call the new economy. In 1990, prime interest rate was 10%, and now it is 4.75%. And this has had an impact on where you are saving money and where you are investing, because obviously dividends, CDs, bonds, and things of that nature were yielding a lot more in 1990 than now. In 1990, there were 45 million Americans that they were over 50 years old, and now it is fast approaching 100 million. And there are between 12,000 and 15,000 baby boomers retiring every day, putting a tremendous strain on Social Security and Medicare while taking money out from qualified plans. Life expectancy was 75 years in 1990, and it is 86 years now, due to advances in medical technology and treatment plans. The highest marginal tax bracket has increased from 31% in 1990 to 37% now. The biggest issue we see is that the national debt has increased from over $3 trillion in 1990 to over $30 trillion now. The fact that we have a larger amount of older people with higher life expectancy, higher marginal tax brackets, lower interest rates, and much higher national debt makes it a necessity to be more efficient with our savings and investing dollars. And therefore, a complete understanding of the infinite banking concept is extremely important. The American family balance sheet. As we met with this family, we learned that they earn about $41,000 a year in income. We also found out they are spending about $68,000 a year. It's already easy to see there is a big problem. They're spending a lot more than they are bringing home. Then we found out that they're already $300,000 in debt and adding to it every year. What would you say to the family to help them? Cut expenses? Lower your lifestyle? How often do you see families have success in cutting their expenses by 5 or 10%? Not often. This family would have to cut their expenses by more than 40% just to break even each year. How realistic do you think that is? Even if they cut their expenses by more than 40%, it will take them a lifetime to dig out of this financial hole and get back to zero. How about bankruptcy? What if bankruptcy wasn't an option for them? What are their other choices? Increase revenue, get another job, another source of income. Knowing what you know about this family, if you had the opportunity, would you want to go into business with them? Would you let this family oversee your finances? No, no one would. Now add 8 zeros to this equation. That family is our federal government. In 2021, we brought in $4.1 trillion of revenue and we spent $6.8 trillion. We owe over $30 trillion and that amount is compounding every year. Let's look at this a little further. What were our choices again for this scenario? Cutting expenses by over 40% just to break even. Do you remember what happened in 2011 when they talk about cutting expenses by less than 1%? The government shut down and within 2 weeks, the stock market was down by 10%. How realistic do you think it is to expect a budget cut of more than 40%? Which leads us to our next option, increase revenue. Where does the federal government get its revenue from? Taxation. If our budget isn't going to be cut by over 40% and we want to avoid our country going bankrupt, how likely is it that our taxes are going to increase in the very near future? In the 80s and 90s, we were in a decreasing tax environment. In 1981, our federal debt was under $1 trillion. Now it is over $30 trillion. Based on what we have just discussed, do you think taxes are going to go up or down? In his 2010 book, Come Back America, David Walker wrote, if significant fiscal reforms are not enacted in the US, interest rate on the national debt will rise and federal taxes could easily double from current level by 2030. But who is David Walker to make such a claim? David Walker served as Comptroller General of the United States from 1998 to 2008. While at the Government Accountability Office, or GAO, Walker undertook a number of transformational reforms within the GAO to ensure the fiscal and managerial accountability of the federal government. Where do you store your money? When you consider where you store your money, there are only 3 choices as far as taxation is concerned. Number 1, taxable. where any interest earned, dividends, or realized gains on this account is taxed every year. These are traditional savings account, money market accounts, CDs, stocks, mutual funds, real estate, corporate, and treasury bonds. Number two, tax deferred. You have deferred the tax to a future date at an unknown rate and possibly on a larger amount. These are assets such as 401ks, IRAs, pensions, and annuities. Number three, tax-free. IBC policies and Roth IRAs. If you believe taxes are going to increase in the future, where would you rather have your money stored? Obviously, in the tax-free category. Yet $19 trillion of our assets are stored in the tax-deferred category. There is an unknown outstanding tax bill on those assets. Could you tell us the difference between saving and investing as verbs and savings and investment as nouns? Saving is money you cannot afford to lose. Investments are money you are willing to risk a possible loss for a possible higher return. The definition of risk is the possibility of loss. They are two very different things with different purposes and functions. One of the greatest mistakes made in typical financial planning is combining the two and not recognizing the importance of keeping them separate. Here's what we mean by that. As we meet and talk with people, they will tell us that they are saving X amount every year in the XYZ mutual fund or in their 401k, IRA, etc. We regularly see people bringing in their statement from their 401k savings plan. There is not a single saving component in that plan. Other than possibly a single guarantee interest fund, everything offered in that plan falls under the investment category. Understanding the difference between saving and investing. How much is your family comfortable saving and how much are they comfortable investing? If you could build your perfect investment or savings tool, what characteristic would it have? Where would you warehouse that wealth? Now, let's talk about the characteristics of the ideal investment or savings tool. If you could wave a magic wand and create your ideal savings or investment vehicle, what characteristic would you give it? Number one, competitive rate of return. Number two, guaranteed safe. Are the returns contractually guaranteed? Number three, liquid. How easily it is to access the fund. Number four, tax-free. Number five, creditor protected. It cannot be taken away. Important for many business owners and medical professionals. Number six, uninterrupted compounding. Any interest every day, every week, every month, every year on the entire asset. If you are paying taxes on that asset, then it is not really uninterrupted compounding. Now, let's take a look at how these ideal characteristics apply to these tools. Let's take a look at 401ks and IRAs. Do they have a competitive rate of return? We hope so. Are they guaranteed? No. Although some plans do contain a guaranteed interest account within the investment choices, for the remaining investment options within the plan, returns are not guaranteed. Are they liquid? No. Are they tax-free? No. Are they creditor protected? In some states, 401ks are creditor protected. Do they have uninterrupted compounding? No. Brokerage account, stocks, bond, mutual fund. Do they have a competitive rate of return? We hope so. Do they have guarantees? Are they safe? No. There are no guarantees on the rate of return. Stocks, bonds, and mutual funds are investment and can lose money. Are they liquid? The literal answer is yes. You can access your money, but depending on what type of funds they are. Are they tax-free? No. Stocks, bonds, and mutual funds are taxed on any interest earned each and every year. Result at a profit, they generate capital gains tax. Are they creditor protected? No. Do they have uninterrupted compounding? No. Let's look at savings accounts, CDs, money markets. Do they have a competitive rate of return? No. Do they have guarantees? They do have a guarantee interest rate, but in today's economy, what is that rate of return? Less than 1%? Are they liquid? Yes. Are they tax-free? No. You are going to pay taxes on that 1% every year. Are they creditor protected? No. Do they have uninterrupted compounding? No. Not if you are paying taxes every year. Let's look at infinite banking concept IBC policies. Have you ever heard that a life insurance policy is a bad place to store your cash? We have, and we even agree if we are simply discussing a traditional policy. When you buy a traditional life insurance policy, what do you look for? The highest death benefit for the lowest premium, right? That means the internal expenses are going to be higher and the cash value is going to take a very long time to accumulate. But what we are talking about are infinite banking concept or IBC policies. They are specifically designed with the lowest possible death benefit while accommodating the highest possible cash value. This way, the policies are designed to be an asset and savings tool rather than an expense. It's changing the purpose of the policy to a living benefit rather than a death benefit. Infinite banking policies, IBC policies, do they have a competitive rate of return compared to other savings tools? Yes, absolutely. Is it safe, guaranteed? Yes. The internal rate is contractually guaranteed and your cash value will never be exposed to market risk. Is it liquid? Absolutely. Is it tax-free? Yes. You will not be receiving a tax notice at the end of each year on the gains in the policy, and when done correctly, it is possible to access the fund within the policy without paying taxes. Is it creditor protected? Yes. Do they have uninterrupted compounding? Yes. Do you know who the largest owner of IBC type policies are? Banks, and they are called BOLI, or bank-owned life insurance. Now, let's look at how we use the money we save. You finance everything you purchase. If you borrow money from an institution, you are financing and paying interest to them. If you pay cash, you are removing that cash from whatever warehouse you are using and removing that cash from the pool of money that was earning interest. So not only is that money gone, but so is the interest you could have earned. That's called opportunity cost. You are either paying interest or losing interest on every financial decision you make. The question that must be answered then is, what is the best way for you to make those purchases in life? Cars, homes, businesses, weddings, college, retirement. Let's take a look at how that works. Let's look at purchasing a car. What's the typical way we purchase a car? Get a loan, usually with a 5-year repayment plan. So now we are in debt. We are the spender. Then we spend the next 5 years trying to get back to zero, right? That's our primary goal. Get that loan paid off, getting back to zero. See, big zero in yellow. But are you only ever going to buy one car? No. So you start over. The entire time you have been paid interest to the financial institution. So what if we pay cash? First, we have to save our money. We are the saver. Where's that money warehouse? Unless you have an impressive mattress, it's resided on some sort of financial institution, hopefully earning interest. When we buy the car, what happens? How much interest am I earning on that money I removed from the pool of money? None. So what happened next? I have to start saving again to replenish the money. When the payments were going to a traditional financial institution, did you pay interest? Yes, of course. When you use your cash to make the purchase, do you charge yourself interest? Probably not. After you spend it, how much interest are you earning? None. You are back to zero. So not only did you forfeit any possible interest earned, but you also didn't give your money the same level of importance you gave someone else's. Now imagine that happening over your life. How many cars would you purchase? How will you pay for them? Who will benefit from those purchases? Whoever is getting the interest on the money. What if there was a third option? In an IBC policy, the policy is billed as an asset. What we mean by that is that you are able to collateralize, take a loan against the cash value in your policy. Your money actually stays in your policy, earning interest and compounding every day, every week, every month, every year. We are the wealth creator. Your money never stops compounding. You believe in forever compounding interest? If so, when would you ever want to stop it? How could this concept positively impact you or your family in the future? Examples of wealth creators are Ray Kroc, founder of McDonald's, and Walt Disney. They both borrowed money against the cash value of life insurance policies to create two huge businesses and very well-known brands. Pedro started in the financial services industry in 1994 and ISIS in 1996, both serving as full-fledged typical financial planners. In 2005, ISIS and Pedro established their own company, Universal Wealth Manager LLC, in the city of Coral Gables, a suburb of Miami, Florida. Its mission is to provide its clients insurance brokerage and financial advisory service of the highest quality, based on its tenets of experience, trust, integrity, and objectivity. During the 2008 financial crisis, they came to the conclusion that conventional financial wisdom was based on faulty premises, and to properly serve their clients and protect them from the greed, corruption, and irresponsibility of Wall Street banks and financial institutions, a paradigm shift was in order. After studying in depth the infinite banking concept, they realized that the only way to control your financial future was to control the banking function yourself. Since then, they have become evangelists for this concept. They are very well versed in the infinite banking concept and practice what they preach, as they own several of these policies. Their exceptional ability to explain complex concepts in simple terms allowed them to educate, coach, and serve a diverse clientele that includes families, business owners, professional, real estate investors, and high net worth individuals throughout the United States. They have been guest speakers at the annual IBC Practitioner Think Tank Symposium. Isis obtained her MBA from Barry University in Miami Shores. Pedro graduated from prestigious Columbia University in New York City with bachelor's, master's, and doctoral degrees in engineering and applied mathematics, and with an MBA with emphasis in strategic and financial planning, obtaining all his degrees with the highest honors. He's fully bilingual in English and Spanish. Isis and Pedro are very active in the business community. You can contact us toll-free at 1-844-443-8422. You can email us at contactus@infinitebankingsimplified.com. You can visit our website at www.infinitebankingsimplified.com and take advantage of all the information that we have there on Infinite Banking. Now we encourage you to watch and listen to part 2 of this presentation.